Now, question number 23 says, the following draft financial statements relate to H Limited and its investment companies S Limited and A Limited for the year ended that 1st of December 2022. We have the non-current assets, we have property, plant and equipment for both the holding, the subsidiary and the associate. Then the intangible assets, the investments, current assets, inventory, trade receivables, cash at bank, total assets, ordinary shares, retained profits, shareholders' funds, non-current liabilities, 10% stock, loan stock, current liabilities, trade payables, bank overdraft, current tax, total liabilities, total capital, and liabilities. Then the following details relate to the acquisitions. We have the company, the date they were acquired, the cost of the investment, or what we call the purchase consideration, the retained profits, the percentage of ownership. Do you know when you look at these percentages, you're able to tell whether it's a subsidiary or is an associate. H Limited also invested in 25 million of their own stock in S Limited. Okay. On the dates of the acquisition, the value of buildings in S Limited and A Limited were 50 million and shillings 25 million above their carrying amounts. That's their uplifting or the revaluation. Buildings are depreciated at the rate of 2% per annum on reducing balance. The fair value on the non-controlling interest, the NCI, the purchase consideration, can be estimated from the share price of S Limited that was shillings 8 on 1st of January 2019. Now, on 1st of January 2021, H Limited sold S Limited an item of plant at a selling price of 75 million, reporting a profit markup of 50%. Plant is depreciated at 20% per annum on reducing balance. During the year, the company is treated as follows. S Limited sold goods at a selling price of 20 million to H Limited at the normal gross profit margin. 1/4 of these goods remained unsold at the end of the year. H Limited sold goods at the selling price of 40 million to A Limited, reporting a profit of 10 million. Half of the goods sold to A Limited had been sold by the year end. At the beginning of the year, H Limited had goods to the value of shillings 10 million purchased from S Limited in the year ended that 1st of December 2021. Included in the trade receivables and payables of each the respective companies are the following intercompany balances due from H Limited to S Limited, due from A Limited to H Limited. Now, a cross-check in S Limited's books revealed that the receivables of S Limited had shillings 30 million due from H Limited. These anomaly arose because H Limited sent a check of 5 million to S Limited on 29th of December 2022, but had not been received by S Limited. Meanwhile, all the companies had paid their interest on loan stock by the year end. Goodwill, where relevant, had been impaired by 20% on cost at the beginning of the year. An additional impairment of 20% on the initial cost was again reported in year 2022. Now prepare a consolidated financial statement as at that 1st of December 2022. Okay. So in this case now, for the consolidated financial statement, we'll begin here and say solution. This company is called who? It's called H Limited. H Limited. So just call it H Limited Group. And I want to have 4 columns. I want to pick 4 columns. So I come and merge them. HG Group. I get consolidated. Statement of financial position. We are told as at that 1st of December 2022. So here I'm going to have the details. And here I will specify it is coming from which working. Then here I will have the, let me see, they have taken shillings in thousands. So because I take this, in the same case here, I take this. So even these ones, I can also make them bold. So I'll show it's working what? Now the consolidated will have these items with a few additions, so we can pick. Let's copy from here. Let's copy. Sorry. We copy up to here. Copy up to here. We come and paste here. We paste there. Then we try to look at what other items will be there. You know, when we have an associate, when we have this being an associate, this one, we will have an asset here that will be called investment in associates. Investment in associates. Then, when we have that, obviously when we buy these associates, there will be goodwill. So we need to have goodwill. And this one will be coming from the investment in subsidiary. That's where we shall compute the goodwill, or is the one that we should bring here. Then there is something else that you know should come here. You see they had investments, and that investment is what I've called investment in associates. So we are going to have someone called other investments in case they are there. Other investments. And I think those are the ones that will be there. So we have just adjusted the investments in associate, the goodwill, the other investments. So with that, we will have the total non-current assets. So total non-current assets, we can make it bold. And then here I can separate, I can create one line. Then these total non-current assets, we can autofill. Takuja hapa tuseme equals, it will be this value for the plant plus this intangible plus this investment plus this one plus this one. And and then this value we shall give it an upper or top border. Yeah. So this one will be given as a total of these ones. Okay. From there, we go now to look at the current assets. Current assets obviously will have inventory. It will be there. We'll have receivables. They are there. We'll have cash at bank. There is nothing else. So total. So this one, I want to modify it a bit and call it total current assets. Total current assets. Total current assets. Now, these total current assets, I'm going to bring them here, and they will be given as the inventory here. This inventory plus these receivables plus this cash at bank. That is how I shall get my total current assets. Those three, itaziandika kwa hii column. So I enter. Then this figure, I will need to give it a top border. Then I'll need to add another line here, which now will give me something called total assets. Total assets. So the total assets will be here. And these total assets will be given us, or this one I can remove let me remove inaitwaje? The top border. Let me remove the top border, niseme no border. Ndio sasa nikikuja hapa, nitasema my total assets will be this total non-current plus this current. And this figure now I can give it top double. I can give it top double. Top double. Then hapa nikuje, nataka niongeze 2 more lines. Niseme financed by. Financed by. I start with equity. financed by equity. So under equity, we will have the ordinary shares. That's okay. We will have the retained earnings. Then we'll have the shareholders' funds. So these shareholders' funds, I can come and bring it here. Hii niseme itakuwa equals, niweke hapa this plus this, the shareholders funds. Hata hii sababu zimepakana sana, lakini sio sheria ati you keep on putting the lines in between. It just these ones I'm just putting for my own satisfaction. Yeah, sio sheria that you must separate. Yeah, as long as you have the items, that's fine. So, and there is something I've forgotten to put here. There's something I've forgotten to put now that we are consolidating. Now that we are consolidating, oh, actually it should come down here. There is what we call the NCI. The NCI. The non-controlling interest. The non-controlling interest does not have to be in. So hiyo itakuwa hapo. So let me put a line there. So I also need to put another line so that with this now I can have a figure called total equity. Total equity. So the total equity here will be given as the shareholders' funds plus the non-controlling interest. The non-controlling interest. And this one we can give it a top border. That one, we can give it a top border. Rolling stock is on its own. That is the only liability we have. Haya, tukuje kwa current liabilities, trade payables iko sawa, bank overdraft iko sawa, current tax iko sawa. So that will give us something called total current liabilities. So I want to change here. Niseme total current liabilities. Now these total current liabilities, itazileta hapa and zitakuwa zimeanzia hapa. The payables plus the overdraft plus the current tax. If I had 3 columns, ndio ningeweka total liabilities. Sasa now that I have just 2 columns, I will just now have, and this one now that I called it equity, I want to change this name that they have used, but basically the same. So I want to call it total equity. Total equity and liabilities. Total equity and liabilities. So these total equities and liabilities will be given as this total equity plus kuna hii loan stock, this one, plus kuna hizi current liabilities. So there are 3 figures that will come in there. Good. If you are where I am in terms of that table, sema yes. We have designed the frame. We have designed the frame. Sema yes. Aha, 3 people are where I am. Wengine mko wapi? Wengine, where are we? If you are lost, let me know. Wengine, where are you? Immaculate saying I scroll a bit. Okay. I don't know whether you're able to see correctly from there. But kama umeachwa, not much of a problem because we shall go through each one of them. Each one of them. The person who has joined us, Oppo, just said yes. Put your name or let me know your name. Let me know your name. Good. I think we are good. I think we are good. So we can begin. We can begin. Kama umepotea, usijali sana. We shall be visiting each and every item. So you'll see how they are co-working. Now, as you know from your FR, it is always easier or advisable to begin with values that do not require workings or that are so easy. Because in marking of FR, they look for the entries. So unaanza na zile ziko rahisi, ndio maybe time ikiisha, at least you'll have scored several entries instead of starting with a working that will take you a lot of time. And as you know, we always begin with ordinary share capital. because ordinary share capital, you only need to bring the one for the holding. So just come here for the ordinary share capital. You say equals. We go to the statement up here. We get the ordinary share capital for the holding, this 2 million. The 2 million. We put it there. Beverin, you have joined us VM. Beverin, let me know. I can change you from my end. Chat your name, VM. Okay, so I'm going to put you in the waiting room. So if you find yourself no longer able to see us, you can then chat me in WhatsApp so that I get to know the correct name. Okay, good. That's what I was waiting for. So let me change you from this end. Yeah, we are now good. All right, so we already have put the ordinary shares. Hiyo tumesema does not require workings. Something else that will not require workings from our figures, is the bank overdraft. So let's go to where we have bank overdraft is at the liabilities. This one hapa ndio tumesema tutaweka liabilities, tumesema tutaziweka hapa. So bank overdraft. So bank overdraft, we will go up there. We will go up there where there is bank overdraft. We take the one for the holding company, this one, plus this one of the subsidiary. Send me your answer. Send me your answer. The bank overdrafts. We only pick the one for the holding, Jacinta. You have picked, your figure means you have picked the payables. Yeah. We are picking the bank overdraft. The bank overdraft. So the 0 plus this one. So when I press enter, so it is this one. Yes, good. So I enter. The next one that does not require working so much is the current tax. Let's go to where there is current tax. We say equals. Current tax does not require workings. We just take it the way it is. This liability, this one. So you take this plus this one. Give me the total. Give me the total. The current tax, the liabilities we pick for both the subsidiary and the holding. And they have not, when we say they don't require workings, we are saying they have not been mentioned in the additional information. Yeah, so we have the 65. Something else that has not been mentioned in the additional information is intangible assets. So intangible assets, let's come here. Intangible assets, we are going to put them here. Intangible assets. So intangible assets, we go for them up there. We go for them up there. So sasa hiyo acha nisongeshe hapa. So the intangible assets, we pick this one of the holding plus this one of the subsidiary. They are assets of the group. So those ones we also do not require adjustments. The next one, though it has been mentioned, is the cash at bank. Tukuja hapa kwa cash at bank. Cash at bank tulisema tunaziweka hapa. I think that is what we said. We are putting them here. We are putting them here. We are putting them here. So cash at bank equals. So we are supposed to take the assets of the two companies, that is the H and S. So let's go up there. We find that the cash at bank, I've cleared you here 14, C14. Holding had 100 and the subsidiary did not have. The subsidiary did not have. However, we are told by some information. Let's go to, there is information we read. There is information we read somewhere. There is information we read somewhere. Information 4. This one, This information 4. Hapa. A cross check in S Limited books revealed that the receivables of S Limited and had 30 due from H. These anomaly arose because H Limited sent a check of 5 million to S Limited on 29th of December, but had not been received by that first. So this check, it has not been received by S. It has not been received by S. So it is still in transit. And as now we do the books of accounts by that 1st of December, hiyo pesa bado iko kwa H. Hiyo pesa bado iko kwa H. Although they have recognized it in their cash book, bado iko kwa H. So we need to return it. It's called the cash in transit. Now that we do not have the 5,000, in its own cell. What we do, tutarudi hapa juu, tuseme plus 5,000. The cash in transit. So sema equals, uniambie unapata nini? Sema equals, tell me you are getting what? Okay. Then, so we are getting 105. Now, closely related to that, we have now these receivables. Because sasa hiyo 5,000 iko hapo. So hii receivables, it is also the same concept. Tuende hapa juu, tuchukue receivables for the H. Receivables are H 175. Then we add the receivables of S. Then we less kuna intercompany receivables. So intercompanies, so they are included in both. So here you see now here due from H to S. So S is claiming some money from H, this one. So this one we should subtract it. We should subtract this. So we subtract that because already included. Then remember there it is supposed to be 30,000. This one, 30 million. But why it was written this is because there was cash in transit. So that cash in transit, again, we need to factor it. 5,000. So you minus 5,000. So there is the one for the holding, the one for the subsidiary. Then you remove the intercompany's receivables, which is supposed to be 30 million. So give me the answer. Give me the answer. Yes. So I enter 215. And closely related to that are the payables. So payables, tuteremke hapa chini, tuzitafute, we deal with them because imetajwa hapo. Now the payables again, we take the one of the payables. So we have this one of H plus this one of S. Then you minus the intergroup. You minus the intergroup, and we do not now include the cash, is already included. So the intergroup is this one. So you minus this one. Because as a H inajua it has to pay 25. H inajua it has to pay 25 because they already have dispatched a check of 5. So that's why we are not including the 5. So press enter. Tell me how much that is. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000. 1,000,000 Okay, good. So we have that. There is also something else that is not touched or it does not have a lot of workings. Huyu anaitwa loan stock. Huyu loan stock tulisema tunamweka hapa. Loan stock tulisema tunaweka hapa. Loan stock tulisema tunaweka hapa. So tutasema equals tukibia huku juu kwenye kuna loan stock. Loan stock, this one. H wako na 100 na S wako na 75, the subsidiary. But we are told niliona wapi? This one, that H also invested 25 in the loan stock of S. So there is double counting. So that S, that 25, the intercompany must be removed. So we click here and we say minus 25,000. Yeah, the intercompany. So press enter. Let me know that is what. Good. So hii side tumebakisha tu kujua retained profits na the NCI. Okay, tumesonga, we have made good progress. So you see those are significant entries, eh? There are many entries that do not require a lot of workings, and that is how we go about it, eh? Una target tule to korahisi, kwanza you put them. Now from there, the others now will require a bit of workings. So let's now go one by one, starting from here. PPE, we can say this will come from working 1. Will come from working 1. This will come from working 1. So tuende hapa chini tuseme property, plant and equipment. Working 1. Property, plant and equipment. Now, as again, you know, we also need to take the assets of the two, the subsidiary and the holding. So we will have the one for H Limited. We will also need to bring the one for S Limited. And then we were informed in note 2. In note 2. Is it note 2? No. Note 1, this one, On the date of acquisition, the value of the buildings were 50 and 25. So that is a revaluation. So we need to bring it as part of the valuation. We now account for it. We need to account for it. So tukuja hapa tuseme fair value uplift. Fair value uplift. Uplift or revaluation. And this revaluation, we only bring in S Limited. In S Limited, yeah. What else do we require? Now, when we are dealing with the assets, you begin with the opening values, then you add all those items that can make the value to go up. And there are basically two. There is the revaluation and the acquisition. The revaluation and the acquisition. Then you less the items that can make the value to go down. And again, that is disposal and the revaluation loss. The revaluation loss. So in our case here, we already have put the revaluation. We have put the revaluation, so we will add, and then we are going to say less. This question has been mentioning depreciation. So, and as we said last time, when you look at these values here, and you can only see a single value, it tells you that you are working with the net book value. The net book value. Depreciation has already been factored. Depreciation has already been factored. So any other depreciation that you factor will only pertain or relate to the revaluation. Yeah, so this depreciation here is what we shall capture because we are dealing with the net book values. So I'm going to have a depreciation of fair value uplift. So depreciation of fair value uplift. Higher. What else can contribute to the change other than the depreciation? There was a sale. There was a disposal, as I had said. There was a disposal. So this disposal, let's see what happened to, or how it happened. Tulikuwa tumeambiwa wapi? Where did we see they had sold? Information 2. On 1st of January 2021, H Limited sold S Limited an item of plant at a selling price of 75 million, reporting a profit markup of 50. Yeah. So, there is that now issue of disposal. But because this disposal went to the same group, we will not capture the costs. What we normally capture is the profit that was gained. That profit should be removed. That profit should be removed. It's what we call the unrealized profit. And this profit, because when H sold to S, they sold to them at 75. So S has been reporting this asset at 75. They have been reporting it at 75. But this 75 is a makeup of the costs plus the profit. S Limited has been charging depreciation based on the 75. Now that is a mistake because the profit should not have been made, and therefore even depreciation should not be charged. And from your consolidation notes, you know that is called excess depreciation. That excess depreciation, we need to consider it and adjust accordingly. So, and again, to bring it closer, when they charge at 75, they charge more. So depreciation is more. So it has had the effect of reducing our net book value lower than it should. It has had the effect of reducing the net book value lower than it should. So tunastahili kuirudisha. So the excess depreciation. So nikishasema hivyo, tutakuja hapa. We already have said less depreciation for the fair value because it's one of the items that reduces the value. Something else that you are supposed to less is the UPFA. We call it the unrealized profit. Unrealized profit on fixed assets. We are going to less it. Then we will add back what I've called excess depreciation. How do I add excess? Excess depreciation. Excess depreciation. Yeah, so those are the items. So to summarize, I've said when you're dealing with plant, you begin with the values, then you add the items that make the cost go up. Na hiyo ni revaluation gain na acquisitions. Then you less those items that make the cost go down. And that is a disposal and the depreciation and the revaluation loss. Good. This one I can make it bold. Na ukipata swali ulize in case you are not really following what I'm saying. So this one will give us the net book value. The net book value. The net book value. So you can put the figures here. Tuende huko juu, tuchukue the PPE. Why add back? Nimesema hivi when a company buys an asset, obviously at a price. This price is made up of the costs and the profit. Or I put it the other way around. So to say the cost was 100 and the profit was 50. So the price is 150. The price is 150. So when this company comes to compute depreciation, assume depreciation is 20%. So 20%, so the depreciation, 20% of 150 will be what? Mm-hmm. 20% will be 30, yes. but they were supposed to have charged 20% of the 100. The 100, which is what? 20. Because this profit was not supposed to be included. So the effect is that they charged more. The effect is that they charged more. So if the assets were supposed to be 150, they less 30. So they recorded a net book value of what? 120. But they were supposed to have charged 20. So they should have recorded 130. So this excess depreciation must be added back here so that we go to the correct one when we have removed this 50. And if you want even to remove that 50 from here, you can remove it. Tukitoa hapa hiyo 50, because you are going to remove it hapo. So tukitoa itabaki 70 na itabaki 80. It's the same thing. Is that okay, Auma? Good. And we are going to illustrate that in a while. So I was here now saying, tuende huko juu, tutafute the PPE ya H. PPE ya the holding company. Ndio hii. Kibia nayo hapo. Tuende tutafute PPE ya S. PPE ya S. Ndio hii. 902. Haya. Tuende nao tutafute the fair value uplift. The fair value uplift. It is just, we can just say equals, although we are going to type because it is mentioned here. It is mentioned here. This one. That on the dates of the acquisition, the value of buildings in S Limited and A Limited were 50 million and shillings 25 million above their carrying. Yeah. So that above is the uplift, is the revaluation, is like a revaluation. So that 50,000 ndio tutaweka hapa. $50,000. Hivyo. Then we less the depreciation on the fair value uplift. Now, sasa hiyo, we must have a working. We must have a working. So this one we can call it working. Hii ndio column tunaweka workings, eh? So we can say this is coming from working 2. Working 2. So hii itahitaji working. So working 2 we are calling it depreciation of fair value uplift for S Limited. You know how we compute depreciation, eh? Tunaambiwa hapa juu that buildings are depreciated at the rate of 2% per annum on reducing balance. So kama ni reducing balance, And when were they acquired? S Limited was acquired on 1st of 2019. 2019, and we are doing our books. We are doing our books as that 1st of December 2022. So utakuja hapa, tunajua hii maneno vizuri sana, details. So details wa tunaanza na opening net book value. Then you say less annual depreciation charge at 2%. Ndio wamesema. Then we get the closing net book value. So this is the year 2019, 2020, 2021, 2022. So this one I can remove the decimals, I can make them bold. I remove the decimals. Haya. So the opening book value is this one. Hii tumeweka hapa. This one. Hii ndio tuna depreciate. So you put it there. So tukuje hapa tuweke formula. Tuseme equals this one times 0.02. Press enter, give me the answer. Yeah. So tukishaweka hiyo, that is a formula. So tulisema hii formula unaidrag mpaka hapo. That's a formula that we have put there. You drag up to that point. When you drag up to that point, unakuja hapa. The closing is equals to this one minus this one. That is also a formula. You drag it mpaka hapa. It's a formula you drag up to that point. Haya, so if it is a formula, tukuje hapa. Tuseme equals, kuna hii. The opening for 2020, the opening for 2020 is the closing for 2019. This one. And then now you can run away with this. I mean, now you can run forward that way. So this depreciation here, this depreciation, we can now bring it here, equals the sum ya hii depreciation kuanzia hapa mpaka hapa. Close the brackets, press enter, give me the answer. Hiyo ndio depreciation wanafaa kuwa wamecharge tangu waliacquire. Aya, so I can see the figure. So tunaiweka hapo. So when we put it there, let's go look for the unrealized profit. The unrealized profit. This unrealized profit, what were they saying on these assets? They said that they sold these at 75, reporting a markup of 50%. Reporting a markup of 50%. So remember, markup is expressed in terms of the costs. And when you are given the price, you must get the margin. You must get the margin. You must get the margin. So, just wondering how to put that. Let me see whether I can fix it here. We are given markup. Markup here. We are given markup, Markup na kuanga na numerator. Numerator, it is 50. And then the denominator, how do we write that? Denominator. What? It is 1. So that when you divide this, it comes to 100. Now, if you want to get the margin, what we do, the numerator is the same. So denominator, what you do, you add. You add the numerator to the denominator. That way. Because margin is the price. So margin percentage, let me put it this way. Margin percentage should now be equal to the numerator, open the brackets, or you can just go straight. The numerator is this one. The numerator remains. The numerator is the same, whether uko kwa markup ama kwa margin, because numerator inakuanga profit. So you divide by the denominator ya margin, this one. So this one, you can make it a percent. That way. So I hope you have understood. That arrangement. Haya, kama tumeelewana hapo, I was simply looking at how do I convert This is what I'm trying to illustrate. This is what I'm trying to illustrate. It's only that I don't have some good space there, Missouri. We know that markup is profit over costs. And we know margin is profit over price. Now, this is the same thing as profit, just like what I was illustrating earlier. If you get the costs, you add profit. You add profit. That gives you the price. That gives you the price. So now, if markup is 50%, it is simply telling you it is 50 out of 100. Then, going by what I'm saying here, margin should be 50, the numerator. Then I take my denominator, I add this, and this is 50 out of 150. That is what I was trying to explain there. Is that understood now? Good. So if it's understood, tunasonga. Jaribu kuona kama tunaweza maliza hii swali. Sitaki kusikia tutairudia next time. Tusipomaliza nitakuachia. Okay. Haya. Good. Haya, if it's clear, that's good. So sasa you can screenshot hii. You support with what I've already put here to make your work easier. Haya. So now, if I want to know the profit, maybe I could also come here and say that niandike tu formula, niseme that profit should then be equal to price times margin. Yeah, that one you can also put it as part of our, itatusaidia hapa. Itatusaidia hapa. Now that I know my margin, I will simply say equals this one times waliuziwa ama waliuza whatever that price at what? Tulikuwa wapi? Hii at 75 million. So that 75 million, that is the price. Sasa hiyo ndio nitakuja ni multiply nayo hapa times 75,000. So do that, uniambie hiyo profit ni ngapi? Yeah, 25. Then I need to go look for this excess depreciation. Now this excess depreciation is going to be charged on this one. It's charged on this one. And I can copy hapa. Naona kuanzia hapa. Let me copy. I come and paste here. And I want to paste without the formulas. without the formulas, so that now I say this is working 3. Depreciation. Now this one I will just call it the excess depreciation. The excess depreciation on profit of asset sale. Hiyo Kiingereza sijui kama inakubaliana vizuri, lakini unaelewa what I'm saying. Haya, then tuangalie wana charge depreciation at what percent for this plant. They are charging at 20%. So they are charging at 20%. So nitarudi hapa niseme at 20%. And something else that you need to check is when was this asset sold? When was this asset sold? So the asset was sold on 1st of January. Was sold on 1st of January. And we are doing our books as at that 1st of December 2022. Meaning that this asset has been with us for the year 2021 and 2022. The asset has been with us for the year 2021 and 2022. Higher, how much are we charging? It is equals to this 25,000 hii. Hii ndio tunatafutiria. Hiyo 25,000. Hiyo 25,000. Then we are going to charge depreciation to say equals, you take this amount here times 0.2. Press enter, give me the answer. Press enter, give me the answer. Yeah, good, 5,000. Haya, sasa hii nayo tuseme equals this 25 minus this. Na hii formula tungekimbia nayo mpaka hapa ya 5,000. Alafu sasa hii nayo tubadilishe tuseme equals this 20. Na hata hii tungekimbia nayo mpaka hapa. Yeah. So hakikisha you have something like that. So if we have that, tutakuja hapa tuseme excess depreciation is equals to, now they are just two, this 5,000 plus this 4,000. It was not supposed to have been charged. So let's now get our net book value. So net book value will be what we began with in in H, plus what we began with in S, plus the fair value, the revaluation that was not captured. Then we less the depreciation, this one that should have been factored, the depreciation. Then we also less profit. This profit, we cannot make profits on our own. So that profit should also be less. That profit should be less. Then this depreciation, this one, we add it back because it was charged when it should not have been charged. We add it back because it was charged when it should not have been charged. So now press enter. Tell me what you have. Press enter. One person has it, the others. So tumesema tuna add hiyo za kwanza, tuna add the fair value, we less the depreciation, we less the unrealized profit, and we add back the excess depreciation. Good. The others mko wapi? Yes, so we are in agreement. So if we are in agreement, this figure, you can give it, you can make it bold and you give it a double underline. Is a serious figure. Sasa hii figure ndio tutaenda tupeleke huku juu hapa kwa PPE. Hapa. Equals this figure here. So I think we are good. So if we are good, let's now go look for the other one that will be easier to work on. Ni hii inventory. This inventory. So the inventory, let's go for the inventory. So your inventory sijui itakuwa working wapi. So this excess depreciation we need to have said imetoka kwa working 3. So let's come here and do working 4 on inventory. Now inventory again, we will have what came from H Limited is an asset. We have what came from S Limited. And there were some assets, some inventories that were sold, but had not been sold fully at the end. So we will have what we call unrealized profit on inventory, the UPI. So tuende tutafute hii value, tukibia huko juu, inventory ya H ni hiyo 300. Inventory ya S ni hii. Inventory ya S ni hiyo. Alafu sasa tuende tuangalie hii mambo ya unrealized profit. So unrealized profit was Kuna mahali tuliambiwa they sold goods. Yes, information 3. S Limited sold goods at a selling price of 20 million to H Limited at the normal gross profit margin. 1/4 of these goods remained unsold at the end. So sasa, this one that they are calling normal, we will take this one. We'll take this one, the way we have derived it. Because there is nowhere else they have mentioned margin. So hii ndio tutachukua. So going by what we already have explained, here, it makes our work easier that it is the 20,000. Hizo ndio ziliuzwa. Times, we multiply by this markup. Sorry, this margin. Ndio tujue profit. That one. Times tunaambiwa only a quarter had not been sold. So a quarter, so I can times open the brackets, 1 divided by 4. That's the quarter. Close the brackets. So press enter. Ndio tujue how much was unrealized profit. Those goods were still there. So tumechukua hiyo 20,000 tukamultiply na hii margin yenye tulicompute, alafu a quarter of it ndio haijauzwa, so we multiply by 1 out of 4. Yes, I can see that figure. So the total here it should be equal to this one that we had hii ingine S, then we less this profit. We less this profit, this one. And when you less, you get something like that. You double underline and make it bold. Haya, sasa tukibie huku juu kwenye kulikuwa tunafaa kuweka inventory hapa. Tuseme equals. We bring this value of the inventory. And we tell whoever is following our work, hiyo tumeitoa kwa working for. Hiyo tumeitoa kwa working for. Haya, kama tumeitoa huko, the next one that we can do is this one, other investments. Hatuja compute mpaka goodwill, but I think other investments is easier. So working 5. Other investments. So other investments, once again, we have what S already, H already has. We have what S already has. And we will also bring, bring what we call investments in. So we less the investment in subsidiary and investment in associate. Yeah, because they are already included hapa kwa H, because hiyo ni mali yote ya H, so we need to less them, and that will give us the total. So tuende mahali kumeandikwa other investments for H Limited. These investments, kuna hii. They had invested that. S, wame invest this one. Wapi iko hapa. So S, wame invest here. They are part of their investments. But as we have said, the subsidiary is included in this H investment. It's part of the investment of H. So we need to know what is the purchase consideration that they gave for the subsidiary. So taenda hapa tuseme equals, tuende tuangalie hapa juu walilipa pesa ngapi, so that they could acquire the stake in S. This one, this cost of the investment, this one. This one tuiweke hapo, na vile vile tuende tuangalie walilipa pesa ngapi ndio wa acquire this stake in the associate. The purchase consideration, this one. Cost of investment. So if you want now to know the true picture of the investments, other investments, it is this one plus this minus these two. I'm saying they are already included kwa hii 11. So we subtract and we also subtract this. So sema equal, unipatie jibu. Okay, good. So this one is also a serious figure. We double underline. Tukibie hapa, tuiweke other investments equals. Haya, let's now go and compute the goodwill. Let's go and compute goodwill now. So working 6. So goodwill, you know, it is the excess of what you have paid over the realizables. What you have paid over the realizables, eh? So tunaweza kwanza ipanga hapa namna hii. Tuseme details. The first thing that we will get is the consideration paid. The consideration paid. Higher. We will also get the fair value of the NCI. Fair value of non-controlling interests. So that will give us something I would call the subtotal. Sasa inaandika namna gani? Subtotal. Then I will less the assets. The value of the assets, the net assets acquired. Net assets acquired. And you know the net assets acquired, they are usually presented by, we'll have the ordinary share capital, the ordinary share capital, which is closely followed by the retained earnings. Kulikuwa na share premium. Let me see. Okay, hawana. So it's just followed by the retained profits. Retained profits. Retained profits. As at acquisition date. Then there is revaluation. Yeah, so that will give us the total value or of the assets. When you compare now with what you paid, the difference ndio tunasema is the excess. That is called goodwill. Now this goodwill, you know, it's always impaired. So say less impairment, and we have accumulated impairment and specific for this year now. Specific impairment. And this now will give us the figure yenye tutakibia now pale juu, net goodwill. So hii tunaweka ya S Limited na tunaleta ya the associates. So I hope you are there. If you are there, sema yes. Okay, good. Haya, so consideration ni hii tu iko hapa. Hizi investment tunaweza ichukua hapa ama huko juu. And because tuko nayo hapa, tuchukue hii 750 ingie hapo na hii 300 ingie hapa. Namna hiyo. Now the non-controlling interest. The non-controlling interest, it will be equal to it will be equal to, you see, we acquired, we acquired what percent? We acquired 80. So there is a 20%. So we can open the brackets. We say 1 minus this 80. Yeah. That is the NCI proportion. Times the share capital. So we open the brackets. Now the share capital of S Limited ilikuwa wapi? Ndio hii. This one. You see this one? This one. That's the share capital. That share capital. You divide by the par value. The par value is 5. The par value is 5. When you divide by the par value of 5, that gives you, we close the brackets, that gives you the number of shares. The number of shares. That gives you the number of shares. But we are told the market value of one share is here. The value of non-controlling interests, purchase consideration, can be estimated from the share price of S Limited that was 8 shillings. So you type 8. So that would be the value. So press enter and tell me how much that is. Press enter, tell me how much that is. Yeah, good. So 160. So the subtotal now should be equal to this plus this. And this figure, I can give it a top border. And then I autofill hapo. That is the subtotal. Higher. I need to bring the ordinary share capital. So the ordinary share capital for S tutaileta yote. Why do we bring the whole of it? Because we already have included the hii iko wapi? This one. Because we have included the NCI. But when we come here to the associate, we only talk of the percentage that we have purchased. We only talk of the percentage we have purchased, which is this one. 30% times the share capital of A, this one. Once again, press enter. Let me know how much that is. Press enter. Nijue ni ngapi? 30% of this 400. %30 of the 400. Only one person has given yes. Okay, that is 120. Retained profit as at the date of acquisition. So as at the date of acquisition, tukimbie hapo juu tuangalie hawa retained profit yao ilikuwa ngapi. The S Limited ilikuwa amenenewa wapi? Ndio hii, this one. As at the date of acquisition, unaweka hapo, na hiyo tunaweka yote because we are including the NCI. Haya, then hii gine we only put the percentage that we have purchased. The percentage that we have purchased. This 30 times this 300. The 30 times 300. That way. The 30 times 300. Alafu sasa kuna revaluation. Revaluation of these assets. Remember, revaluation goes to equity. Na hii revaluation tulikuwa tumesema hapa juu ama tumesoma this one. Kuna hii ya 50 na hii ya 25. Hii ya 50 na hii ya 25. Easy. So sasa tutakuja hapa takibia hapa chini tuseme equals 50,000. Hiyo naweka hivyo, tunaweka ikiwa full, na hii ingine equals 25,000. Lakini hii 25,000 lazima ikuwe multiplied na ile percentage yenye tulinunua. Hii you must multiply that 25,000 by that percentage. Yeah. So with this now, we can be able to get our goodwill. How do we get our goodwill? It is this 910, hiyo ndio pesa yenye tulilipa, minus the worth, 500, minus this one, minus this. So tuligogwa goodwill ya 160. Na hata hii unaweza, you can autofill. So the goodwill for that company, or those two companies, iko namna hiyo. Haya, impairment. Impairment is mentioned here. Goodwill, hapa kwa information 5. Goodwill, where relevant, had been impaired by 20% on cost at the beginning of 2022. An additional 20% of the initial cost was again reported. So by the time tulikuwa tunakuja kuanza this year 2022, tulikuwa tusha impair 20%. Then tukikuja kufunga tuka impair another one 20%. So hapo hii ndio ninaita accumulated hii. So it is equals to this times 20%. Aha, niambie hiyo ni ngapi? Yes. And you can autofill that. And then you come and do the same for the specific. Equals this times 0.2, the same. You autofill. So sasa the net goodwill should be the original costs, you less the impairment. You less the impairment. So when you raise the impairment, tell me what is the goodwill for. Yes, 96. Na sasa hii ndio. Sasa this one, you can make it bold and then you can give it the serious figure. And you know from your consolidation, only the one for the subsidiary goes to the consolidation. So this other one, we shall not take it to consolidation. So tukibie huku juu, this goodwill equals, we take this 96. Haya, time imeisha. Tumeshindwa kumaliza investment in associate. Ndio tukue tumejaza hapo na wapi kwingine. Na retained profits. Na retained profits. Na NCI, non-controlling interests. So there are three things that have remained. So what I'm going to do, because time imeisha, nastaki kuenda mpaka 11. I think I'll give you the hard copy. I'll take the photo of where I have solved it. Nikutumie. You can try to follow. You can try to follow and do you complete. Good. So is that okay? Yeah. So that now we do not take another whole lesson completing on them. Good. So thank you very much. This one, the recording, you may not get it today. Utaipata kesho. Today I've recorded it in a way it will go to YouTube so that I can keep this. Yeah. Okay. So thank you very much. Have a good night. Yes, we have a class on Monday, not unless unataka to declare holiday. What do you want? Do you want us to have a class on Monday? Ama tupumzike? Let me see a few reactions. Yeah, being a long weekend, maybe some of us will have traveled. What do you want? Hey, let me have some reactions. Okay. Lucia amesema tupumzike. So we go by that. Hata Rose. Aya. So then Monday tushereke Mashujaa. Yes. Okay. Okay. Thank you. So then we meet on Tuesday, God willing, to pick up from there. Thank you.